Let's say I could pick one dividend ETF to hold forever. Not 5, not 10, just one. Which one would it be? Today, I'm going to show you the one that I would choose and why it's not about what's hot this year. It's about what builds wealth over decades. If you want an ETF that consistently pays you a dividend, helps protect your money, and gives you peace of mind over the long haul, I ask that you stick with me. In addition, you're going to learn some pretty interesting things about dividends that most people will not tell you on the internet. Now, real quick before we jump in, I know a lot of you out there looking for the next winning stock or the next breakout ETF. Trust me, guys, I get it. But what I want you to walk away with today isn't just a name, it's understanding. Understanding of why this ETF has worked well over time and why short-term performance as of late does not scare me, and why a long-term approach beats trying to chase winners. Guys, I buy this ETF every single month. Now remember, you don't buy anything just because somebody on the internet says it. However, when it comes to an ETF, I can understand why it's a lot easier to do that. But today, I want to talk to you about something steady and reliable. SCHD, the Schwab Dividend ETF. Now, SCHD has not been the hottest performer this year. So yes, SCHD is lagging the S&P 500. There is no hiding that. Anybody who denies that is a moron. We've had a big tech surge and the charts are all lighting up green. SCHD has not been that star. And if you're new to investing, that may feel wrong because you see a divergence from stocks to some ETF. You might be thinking, doesn't the best dividend ETF beat the market every year? But here's the thing. I don't see 1 year lag as a failure. It's more like SCHD is the turtle in the race, steady and purposeful. Meanwhile, the rabbits hop up and down. And here's why it honestly doesn't make me lose any sleep at night. I don't invest for 1 year. I invest for 5, 10, 15, 20 years. Let me be very clear. I don't judge an ETF or a stock based on where the chart has gone and where the price has gone in any sort of time frame, even if it's 20 years. That's like judging a basketball player on a few plays, a few games, even one season. You need to look at how they're preparing. What are they doing? How's their trend? You need to look at the whole season. You need to look at all the things they're doing. SCHD, in my opinion, is built for long-term income and stability, not headlines and quick spikes. Another thing, I don't jump in and out of investments. I don't trade SCHD because it lags this quarter. I don't panic sell when it doesn't outshine the S&P. That's not investing. That's emotional reaction. And no matter how smart a company feels in the moment, reacting that way will rarely work out. Now remember, SCHD was designed for income and stability, not for fireworks returns in short bursts. So yes, it is lagging this year, but that doesn't make it bad. Now, if you're new to investing, or feel like you've been spinning your wheels trying to figure out what to buy, I 100% get it. I used to feel the exact same way in a lot of ways. Even today, I feel the same way with the market being as crazy it is. But what if I told you that building wealth is actually a very simple process? You need a simple plan and a few key tools to execute it. Now, why is SCHD different than other dividend ETFs? Well, there are a lot of dividend ETFs out there. Some just chase the highest yield possible. Some include companies that aren't stable. Rather than just chasing companies based on the highest dividends, SCHD focuses on quality first. It looks for companies with strong cash flow, strong returns on equity, a history of growing dividends, and most importantly, companies with good balance sheets. Companies that have strong balance sheets can last the test of time. You don't want a company that pays a big dividend right before it collapses. That's like collecting interest from a sinking ship. SCHD's approach is more like collecting rent from a property that keeps increasing in value, keeps increasing its rents, and making the difference between rent and expenses much greater. That's the key difference. For anybody new here who's wondering, what exactly is SCHD? It is the Schwab US Dividend Equity ETF. An ETF, for those you don't know, means an exchange-traded fund. It's a basket of stocks, a bundle of tons of companies. When you buy one ETF, you're buying a small piece of many companies all at once. In this case for SCHD, it's about 100 companies that pay dividends. ETFs are super low cost, easy to buy through your brokerage, and they update automatically in real time. Mutual funds, on the opposite side, you have to buy them at the end of the day. Usually they're run by some manager who's charging a big fee. But with ETFs, you don't need to worry about which stocks to pick or when to sell or what fund manager is charging you for what. They have a set agenda and the fund sticks to that agenda. And the best part is they tend to outperform those Harvard MBA money managers that are wasting your money by actively managing mutual funds, charging you high fees while also underperforming, a double whammy. And for SCHD, the expense ratio is very low. It costs about 0.06% in fees. Guys, that means for every $1,000 you put in, all they're charging you is 60 cents per year. This is far lower than you pay with most mutual funds or to financial advisors. So let's talk about who is in SCHD's basket. Companies you actually know, big names like Coca-Cola, PepsiCo, Home Depot, Cisco, Amgen. These aren't fly-by-night names, guys. These are businesses that have proven they can make money, and they share that profit with their investors. And because they're diversified across different industries, consumer goods, tech, healthcare, your risk isn't tied to just one sector. Right now, SCHD has an annual dividend yield, a shade under 4%, that pays out dividends quarterly. That's about 1% per quarter. SCHD brings some stability to your portfolio. And even better, if you're using some sort of tax-deferred account like an IRA or 401k, those dividends are going to be tax-deferred until you pull the money out. You can let them compound as you don't pay tax on them until the very end. And when you reinvest them, you keep buying more and more dividend shares with that. Dividend ETFs, who are they good for? Well, I like them for people, in my opinion, that know, okay, like for me, the reason I use them is I don't need to make a killing. I don't need to make 15, 20%. I already have real estate and businesses upstairs that are doing quite well, that are getting me great returns. For me, what's more important is I'm in a place in my life, financially and with my personal life, where all that matters to me is, do I have stable capital growth? And can I get some income off the money that I generate? If I can do both of those, I'm a very happy camper. Now, that doesn't mean I'm not going to buy QQQ at some point, which is the tech ETF. Doesn't mean that I don't buy individual stocks. I have 28 of them. But at the end of the day, my dollar cost averaging is into SCHD. If you're older, for example, in retirement, and you need to live off your money, this might be an ideal place for you to be. It gives you a good, consistent check while also giving you some capital appreciation along the way. Now, not every investor should put their money in SCHD. I see everybody on the internet who loves dividends, and they tend to be young people. And I go, really? To me, you have the length of time to sit there and take on more risk in companies like the tech companies that do great in QQQ. QQQ is heavy on growth in tech. For someone investing over a 20, 30, 40-year horizon, having a piece of that great growth can make a lot of sense. But those come with immense volatility. Now, guys, look at this pretty little chart here going back to the start of SCHD back in right before 2012. Since then, this is the QQQ, and I don't think this includes dividends here, which is very small for QQQ, but it's there. This is S&P. This is SCHD. Now, you might look at this thing and yourself, oh my God, this is a massive outperformance, and it is. But it wasn't at this point. Now, why is that? What happened here? The big tech stocks in the S&P skyrocketed. Guess where those big tech stocks are not? They're not in this. They're in QQQ and they're in SPY. So, my opinion on all this, if you look at QQQ, and granted, we've been in a beige or bull market on QQQ for the last 13 years, but I still believe over long periods of time, it will outperform. Even if QQQ fell in half and SCHD stayed the same, look at where it would be. Falling in half, it would not eat up the full return yet. It would still be beating SCHD. That's why I think for young people, if it makes sense financially and valuations to put money in QQQ. Just to give you an example, QQQ going back to March of 2000, the very peak of the dot-com bubble. If you started investing on that very day of the peak, so you invested nothing along the way, the very peak, the market would have fallen 80% on QQQ. And if you just kept dollar cost averaging all the way down until today, your returns would be over 14.5% per year. Investing starting at the peak. That's incredible. Now, if you look at this, SCHD and SPY are pretty much in check. I do believe, though, that over long periods of time, SPY will outperform, even though here it's because of recent numbers, but it all depends on what you want. It fits my strategy because I don't care about getting an extra % per year. I'd rather have the dividends. But if you're young and you're still saving, buying SCHD just for the dividend, you're giving up a lot of long-term perspective there. And I think that's going to hurt you in the long run. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Now, let me clear up some dividend misconceptions. I always hear people say, I'm a dividend investor. Get that out of your head. What you need to focus on is, can I buy a good company? Dividends, in my opinion, are the very last thing a company should do with its cash flow. Instead, they should pay down debt, buy back cheap shares, grow the company through reinvestment, or make acquisitions intelligently, all before paying a dividend. But people get obsessed with dividends, and there's a reason why companies pay them, because they know people love them. But let me tell you why it's not good. One, they're tax inefficient. When you get a dividend, that's the after-tax money that the company already paid taxes on. So they got this profit, they paid taxes, now they have money in their account. Now they paid out to you, it's taxed again. As an owner of a company, your company paid income taxes on the profit already. If you owned a company right now with an LLC, you wouldn't pay two taxes, one for the company, one for you. It would pass through to your income. So let's say a company in the stock market made $1 billion. And let's say they paid 30% in taxes. They're down to $700 billion. If they paid all of that $700 billion out to its investors, those investors would pay another 30% on that, which would be $210 million. That would take you down to $490 million on the original billion. That's over 50% of the money paid in taxes. So when people say it's a low tax, I just laugh hysterically and realize how stupid they are. Thank you, left. Now, another misconception is that dividends are passive income. Guys, they're not passive income. Yes, I get it that you sit there and go collect a check, but that's no different than saying, I'm gonna buy this ETF, sell it every year, realize the gain, that's passive income. If the income is just because you're realizing it, that's not income. And it's not passive to me. You still have to understand what you're buying. I actually don't believe in such a thing as passive income. You still have to do your homework, stay on top of it, no matter what is going on there. I just have a whole beef on the whole passive income movement. There is no free lunch in anything. And guys, this is exactly why I teach on YouTube. Because I see all these misconceptions out there from all these finance people on Twitter and Instagram and YouTube and think to myself, they don't get it. So I thought to myself, I need to be able to teach this. Because there are simple things that, by the way, I'm not going to be right on everything, but I look at this dividend thing and I'm like, no, I am probably right on this one. And how do I verify that? When I joke with my other smart value investing friends, we talk about everybody's dividend investing. It gets a chuckle out of all of us because we think it's this most naive thing to do. Dividends are awesome. Buffett loves dividends. I love dividends. But if you told me, Paul, I can take this $1 billion of the company, reinvest it and get 20% return, that to me is a much smarter decision than paying out dividends. But the dividend person only cares about one thing. How do I get that dividend? Now, guys, I have schd because it fits my goals, what I want from my portfolio for that portion of my portfolio. But you have to remember, I've got 1,000 apartments upstairs. I've got several businesses that are growing in value and generating cash flow. Only 30% of my money, of my net worth, can even be invested in the stock market. So my portfolio isn't needed to get really high returns. It's to build stable money that I can live off of. It's to buy great companies at good prices. It's to buy low-cost ETFs like schd, and that's why it's in my portfolio. I don't need the fastest rocket ship to 10x returns. I want income that outpaces safe options like 90-day treasuries, and I want good companies that will pay me while I hold them. Right now, schD's dividend yield is better than I can get from short-term treasuries. And unlike bonds, dividends can grow over time. That matters. With that said, if you think I'm naive to think that if the market fell 50% tomorrow, that schd wouldn't fall very hard with it, of course it would. Would it fall 50%? Probably not, but who knows? That is why I dollar cost average every single month. What I do is I sit there and look at this chart. You don't know when it's going to be up, down, up, down, up, down. That's why I buy all along the way. And my return is flattened out like this through all the rigmarole. Sometimes pay a lot, sometimes pay a little, but over time, I pay the same amount of money. I get the exact same return as the market. And it takes all the thinking out. I love it when I do my projections for 21 years from now. I have these goals for what I want to have at 65 so I can make a big decision on what I'm going to do with the remaining 30 plus years of my life. And schd fits into that goal. My real estate fits into that goal. My businesses, like Everything Money, fit into that goal. These are all the things I look at, and also my individual stocks. But dollar cost averaging is so important for everybody to understand because it's literally the simplest way to outperform all of your friends. Now, before we close, if you want to master the way I buy ETFs like schd over time, I'd love it if you downloaded our dollar cost averaging PDF. It's in the description. It is 100% free. It shows you how to invest without guessing, without stress. More importantly, without trying to time the market. And the best part is, if you do this, you will basically outperform all those mutual funds in the long run, over 90% of them, and all your friends. Now, guys, wait until you see what's possible when you combine schd with carefully picked individual stocks in addition to ETFs. So click the video on your screen right now because this is what I do. And the truth is, most investors never learn how to buy individual stocks the right way. They follow hype. They chase headlines. They miss real opportunities because they're worried about looking stupid, going against the grain. But you're watching this and you've gotten this far because you want to learn and you want to be better. Our full investing course changes all of that. You're going to learn how to build a foundation, a real foundation, how to value companies, how to spot opportunities, how to buy with confidence. This is your edge. It's a skill that can lead to market-beating returns in the long run if you play it the right way. So don't just stop at ETFs. Don't leave money on the table. If you want to beat the market, it's not necessarily up here, it's in here. And I explained that in that video. So click now and start learning how the real pros build wealth. Thank you for your time.